Navitas Semiconductor closed its last trading session on Friday, May 29, 2026, at an exact price of $26.60 per share, marking a sharp intraday drop of 6.70% as the market wrapped up for the weekend. While a single-day slide like that might spook short-term traders looking at their portfolios on popular investing sites, the real surprise isn't this minor temporary pullback. The unexpected development driving massive institutional volume behind the scenes is that despite this dip, the stock is up a staggering 429% over the past 12 months. This massive surge happened during a period when the company intentionally slashed its own short-term revenues by abandoning its legacy mobile charging business to go all in on high-power artificial intelligence infrastructure. The standard expectation for a semiconductor stock experiencing a massive multi-100% run is that it must be printing record-breaking profits and riding an undisputed wave of Wall Street upgrades. The reality, however, is a fascinating contradiction that forces us to look much deeper into how we approach online investing. Navitas is still fundamentally loss-making, carrying a negative price-to-earnings ratio, and major Wall Street firms like Morgan Stanley and Rosenblatt have actually maintained sell and hold ratings with price targets trailing far behind the current market value. This massive gap between what traditional analytical models expect and what the actual market reality is presenting creates a high-stakes puzzle for anyone managing an individual brokerage account. When you look at the recent daily swings and trading volumes, you can see a clear tug-of-war playing out. Friday's trading volume surged past 23 million shares as a major insider transaction came to light. Gary Wunderlich Jr., a prominent director at the company, offloaded over $3 million worth of stock right before the weekend. In a normal environment, an insider sale of that size paired with a 6.70% single-day drop would trigger a cascade of retail panic selling across apps like Robinhood or trading platforms like SoFi Invest. But the smart money is looking at why those shares existed in the first place. The sale was linked to a finalized settlement with Live Oak sponsor partners, which resolved a legacy dispute from their original 2021 merger agreement. While the settlement adds roughly 3.28 million new shares to the total Class A common stock count, triggering some very real dilution risks, it also clears away an old legal cloud that has lingered over the capital structure for years. This brings us directly to the core tension animating the entire semiconductor sector right now. Investors using modern digital wealth tools, whether they are analyzing options via the Interactive Brokers trading platform or letting an automated service handle things, are trying to separate cyclical noise from secular structural shifts. Let us look at the macro picture. The broader tech sector has been hyper-focused on massive infrastructure names like NVIDIA stock or Apple stock to gauge the health of the hardware ecosystem. But the hidden bottleneck in the entire tech stack isn't just compute power, it is thermal management and raw electrical efficiency. A high-density server cluster running next-generation hardware requires an immense amount of power delivered at absolute peak efficiency, and that is where the legacy silicon infrastructure starts to crack. The general belief was that traditional silicon chip makers would simply scale up their existing architectures to meet this demand. The reality is that silicon is hitting its physical limits. Navitas has positioned itself to bypass this limitation entirely by betting the house on wide bandgap materials, specifically gallium nitride and silicon carbide. Their recent first-quarter earnings report for May 2026 put this strategic pivot on full display. Total revenue came in at $8.6 million, which actually represented an 18% sequential increase from the final quarter of 2025. This sequential growth broke a multi-quarter downtrend that occurred when management intentionally choked off their low-margin mobile phone charger contracts. For the first time in the company's history, high-power market applications accounted for the vast majority of total revenue, growing roughly 35% year-over-year. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, or if you are avoiding wideband gap chip makers altogether right now. It is vital to hear how real investors are navigating these highly specialized microcap tech plays. To understand how this company arrived at a $6 billion valuation while generating under $10 million in quarterly revenue, we have to look back at their original business model. Founded with the goal of displacing traditional silicon, the company initially found commercial success by putting its fast-charging chips into the consumer electronics space. If you bought a high-end wall charger for a premium smartphone or laptop over the last few years, there was a high probability it utilized their technology to deliver high wattage without overheating. However, consumer electronics is a notoriously brutal, low-margin business, characterized by intense price wars and cyclical upgrade patterns. Recognizing that this path would lead to long-term commoditization, the executive team initiated a massive structural transformation, internally dubbed Navitas 2.0. They systematically wound down their consumer contracts, which sent revenues tumbling from historical highs down to that $7.3 million trough at the end of 2025. That calculated risk is exactly exactly why the stock has decoupled from its backward-looking financial metrics. While a traditional screener on a platform like Schwab Intelligent Portfolios might flag the company for its current operating losses, forward-looking capital is betting on their recent hardware milestones. At the recent chip designer conferences, the company showcased a brand new 20-kilowatt power delivery board designed explicitly for next-generation data center architectures. By eliminating the traditional intermediate conversion stages, this platform allows direct power conversion with a peak efficiency of 97.5%. When data centers are consuming gigawatts of electricity, a single percentage point increase in efficiency saves millions of dollars in operating costs and massive amounts of structural cooling requirements. Looking forward, the trajectory of this stock depends entirely on whether reality can catch up to the massive valuation premium the market has awarded it. There are two distinct scenarios that could unfold over the remainder of 2026. In the bullish scenario, the design wins currently being sampled by over a dozen major data center customers translate into binding, high-volume commercial contracts. As these systems go into full production, the revenue scaling could be explosive, rapidly narrowing the current net operating loss of $11.7 million and validating the massive price-to-book multiple. The bearish scenario, however, is rooted in the very real threat of capital dilution and intensifying competition. Because the company does not generate positive internal cash flow, it remains completely dependent on its cash reserves, which sat at $221 million at the end of March, down from $236 million just 3 months prior. If the commercial rollout takes longer than anticipated, management will be forced to tap the equity markets again, diluting existing shareholders even further. When you weigh the entire landscape, the contrast between expectation and reality becomes crystal clear. The market expects NVTS to become an indispensable foundational layer of the physical infrastructure supporting the artificial intelligence build-out, which is why the stock has defied gravity to trade near its all-time highs despite a negative bottom line. The cold reality is that the company is operating with zero margin for error, running a race against its own cash burn while navigating a massive structural shift in its product mix. For self-directed individuals practicing active self-investing, this stock represents the ultimate expression of forward-looking risk. It is a business that has successfully executed the technical phase of its pivot, but has yet to prove it can achieve the sustained commercial profitability required to protect investors from long-term equity dilution. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.